Everyone, this is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. As we go through this presentation, the stocks that you see on your screen now will be featured in this video. And remember, if there's a particular stock that you have interest in, you can go right to it using the chapters feature on the video. All right, so taking a look at the market, we finished to the downside today. We had our live Q&A that we do every Friday at 2 p.m. Eastern Time over on the Hub Financial channel, and the market was down then, and we talked about we've had times when whatever the market was doing at 2 p.m. kind of changed into the close. Didn't happen today. So by the way, if you're interested in joining us every Friday for an opportunity for a live Q&A, go over to the Hub Financial channel, register there. And while you're here, don't forget to hit the like and subscribe button here on the EWO channel as well. So you have an opportunity for live Q&A, and then you have the opportunity to know when these videos will be posted. So taking a look at the market, we did have a reversal day today. It's pretty interesting because the economic news didn't change much today. On Wednesday, we had the CPI report that came out, and it was a little hotter than expected. But when you did the core CPI, ex food and energy, which those things don't matter, right? I always joked about this when I was doing live events that changing to the core CPI made no sense because we don't eat or put gas in the car. So who cares about what the prices of food and energy are? And obviously that's said in jest. And the explanation that they give you is the fact that, well, those are volatile numbers, so they take them out and everybody focuses on the core. But the headline number was a little hot from an inflationary standpoint, but you take that food and energy out, both of those have been up, and the number was more in line. And the exact same thing happened yesterday when we had the PPI report that came out, which is the producer price index. That's the wholesale level. So the CPI is the retail level. That's what us, the consumers, pay. The PPI is what the wholesale or the companies pay. And then you look to see what the spread is and whether or not, if the PPI is elevated, can they pass that on to consumers? If not, then it compresses their spread, their margins, and what they can make from a profit standpoint. Those numbers really didn't change much. And yet yesterday, we started to move to the upside, and then yet completely reversed it today going into the weekend. Now, last week, we talked about how we had this triangle formation here on the S&P. And by the way, there was some comments on our video last week where somebody said, do you see triangles in your sleep? Well, there were triangles everywhere. So yeah, last weekend I was seeing triangles in my sleep. So as a reminder, don't forget to leave a comment underneath the video. We're pushing towards 40,000 subscribers. As soon as we get there, we're going to give away 4 of our level 3 subscriptions, and that includes directional trading, triangles, which are consolidating patterns, and our AI-based sideways patterns. So it's a great value, and we're going to give 4 of them away, but we got to get to 40,000 first. So go tell your friends to subscribe. I know a lot of you posted that, yeah, I got a few people to subscribe. We appreciate that. Please keep doing that because we do want to give those away. And then that allows you to join us every Thursday night for our insiders meeting for subscribers. And we talked about this last night, that this breakout to the upside that occurred yesterday meant nothing. You have to have a second day, a follow-through or confirmation day, and you really couldn't consider this an upward breakout until we took out that high from September 1st. And this is exactly why. There's a lot of head fakes in the market, sucks in the retail traders. So yesterday you might have been apt to say, oh, it's time to go long. Let's go long up towards that wave 5, and maybe we still break out of this triangle to the upside. But it didn't happen today. There was no follow-through, no confirmation day, reversed right back down. And if anything, it looks like we're trying to sneak out of the lower end of the triangle. Same thing. We'll be looking on Monday to see if there's follow-through to the downside on the move from today. So must have a second day follow-through confirmation day. It's one of the rules that we live by here at Evo Trader. And then looking at the moving averages, you can see we closed dead on the 50-day moving average. So yesterday, we're above all the major moving averages, the ones that I look at least at 10, 30, and 50, and almost completely reversed that today. We did close below the 10 and 30, but right on top of the 50-day. You could say that we edged below it a little bit. But the bottom line here is nothing happened as far as the breakout yet. We will probably see that by the time we talk again next week. We will likely know where things are going. And one of the things that I like to look at with triangles to get an idea of when the breakout's going to occur is the ADX. The ADX tells you the strength of a trend. So when the ADX is very low, it's telling you you're trendless, which is consolidation, which is what occurs in a triangle. So we have the ADX continuing to go down, telling you the market wasn't ready to break out yet. And so that was kind of a tip of the hat yesterday to the fact that even though it looked like we were trying to sneak to the upside, didn't really occur. So we're still where we were last week with the triangle, waiting on the breakout. We take a look at the 10-year with interest rates, and we talked about this Tuesday night in our TradeFinder meeting. And by the way, if you haven't signed up for TradeFinder, you can do it with the link provided, and it's free. We do it every Tuesday night at 9 p.m. Eastern Time. We talk about the markets, we look for trade ideas, and we have a Q&A session, a live Q&A session at the end there. And we have a great community of traders that join us every week. We'd love to have you come along with us. So if you haven't signed up for TradeFinder, do it and join us every Tuesday night. We had a lengthy discussion during TradeFinder Tuesday night about interest rates moving to the upside and why are interest rates moving to the upside. You would think that we are closer to the fact that the Fed is going to be cutting rates than raising further. Maybe we get one more rate hike, maybe we get two more, but why are rates going to the upside then? You would think it would be the inverse, because then when we go and take a look at the yield curve, which is something we've been featuring here, look where that 3-month T-bill is. It's at 5.4%. I actually had someone that was under 30 asking me, should I be putting money in 3-month T-bills? It's hard to tell them no when you can get 5.4%. So what's occurring here is that we are getting an extreme inversion again in the yield curve. So now we're back over 100 basis points again. And it's just, it was just almost comical to hear a younger person asking about T-bills, because that's something that normally I, was a financial advisor for a short period of time after my time as a golf pro before I moved into the world of trading options. So that's a long time ago. I've been trading options for over 25 years. But we would always do, as far as a portfolio allocation, more in the world of T-bills, bonds, etc., for older people, not younger people. But gosh, when you can get that kind of a return on a 3-month T-bill or some sort of a short-term instrument in the bond market, it is tough to tell somebody no there. And we have insurance companies, pension funds, etc., that have a lot of money in bonds, and they are getting killed, because remember, prices and yields move in inverse proportions. So as yields continue to move to the upside, which they clearly are here with the chart of the TNX, that means that people that have bought the bonds are losing money. And so perhaps we're seeing some short covering. It is odd to have a day where we have a pretty significant down day in the equities market, and yet rates went up. They usually move inversely, not like that. And so you would expect to see buying coming in the bond market with the market, the equities market down, not both of them going down price-wise. So remember, with bonds, prices and yields move inverse proportions. So if yields are going up, that means prices are going down. So prices went down in the bond market and the equities market. Kind of an unusual day. And with the continued move to the upside here on the TNX, it's just going to be a very difficult time for the tech stocks. And based on what we saw today, perhaps the market itself. We still hear people talking back and forth about soft landing, whether we're going to have a mild recession. No recession seems to be talked about an awful lot. I just don't see that coming. You have a few correlations that work consistently in the market, and one of those is an inverted yield curve has always preceded a recession. And we haven't seen the recession yet. We're around 15 months now since we had the first inversion of that yield curve. And so people are saying, well, maybe we're not going to have one. I can't let that go. I have to keep that in the back of my mind. You just don't ignore the bond market. There's more money in the bond market than the equities market, and bond traders are pretty sharp. So I think this is something we need to pay attention to, especially if we take out this wave 3 high that goes back to August 22nd. If that continues higher, then yikes. I don't know how the equities market powers forward from there. The dollar is staying stubbornly strong up there around 105, which is where we were today as well. And that also tells you, what are we missing globally? Are global markets concerned about their own economic conditions? The dollar is still viewed as the currency of last resort. And so money is coming in to the dollar. We can try to equate out what's going on in the bond market with some short covering from institutions, insurance companies that are upside down, but why is the dollar continuing to move up? Two things that are very difficult for the equities market to continue higher. So that's why we were very cautious last night in our insiders meeting on the fact that the market had seemed to break to the upside. Then we look at the VIX, and we had broken down, and notice that wave 5 moved from that low that occurred back over here on the 1st of September, but really just barely. We're still at a 60%, so call it the 61.8% fib level, but we did bounce. So yesterday we broke below 13, right back above it. We kind of filled that little gap. Every other time, at least recently, that we've come down to this 13 level, we've had a bounce, sometimes all the way up to 17 and a little bit higher. The last time that we had the bounce was September 7th, and it only went up to 16 before we came back down. Are we starting another run in the VIX and a volatility spike moving to the upside? Once again, not positive for the equities market. If we could have closed lower again, so if we would have had follow through, the same rules that we just talked about, we would have had follow through to the downside and had a lower close on the VIX, then if we could have broken that very strong 61.8% fib level, perhaps we could have been looking at a VIX going down to 12 or 10. We've been there before. It's not out of the realm of possibility, but we're not talking about that today. So we have the weekend to contemplate the fact that we've bounced back above 13. Looking at some of our other equity markets, yep, here's the triangles. And I did like the comment of, do you see triangles in your sleep? We broke not as much to the upside. We actually noted that last night in the insiders meeting, that even though it seemed like we were trying to break to the upside in the DIA, it wasn't as big of a move or big of attempt, an upside breakout yesterday in the DIA, and then once again a reversal, and it looks much clearer like an attempt to the downside. But as I reiterate time after time, today doesn't matter. Yesterday didn't matter. Today doesn't matter. We have to have a second day of follow through or confirmation day. Now, if we close lower in the markets on Monday, now we have to start talking about we might be getting a break to the downside out of these markets. And with the DIA, clearly that previous wave 4, because the wave 5 didn't go past 100%, would be the target. So somewhere under 340 on the DIA. And the Qs, also not much of a shock there that they broke lower. I was surprised yesterday that we didn't have more of an attempt to the upside here, but we really didn't even get out of that trend line yesterday, so that was even weaker. So we've kind of progressed to, we had a little bit more of an upside breakout attempt in the SPY yesterday, a little less on the DIA, even less on the Qs, and clearly an attempt to a downside breakout here. Once again, we have to wait and see what occurs on Monday. But the tech stocks, you've heard me say this so many times, are going to struggle if interest rates stay stubbornly high and even go higher from here. Then you add the dollar on there with exchange rates for international companies, etc., and it's just problematic. The IWM, the one market that didn't have a triangle, so this was my break from having a triangle, but then when you look at this, you're like, holy cow, look at that zigzag pattern set up here. It is quite scary with that B wave right up to the 61.8% level, bringing the 100% extension on that zigzag all the way down to 175. You've heard me over the last few weeks say I was surprised, both back here on the 18th of August as well as the 25th, that as we came down, we didn't come down and test that 180 level, which was the upper end of the range when we had tightened this range, where we'd gone from 170 to 190 to 170 to 180 in the IWM. We did test it back in June, but it just looked like we were going to come down and test it again. We didn't. We bounced up. But now with today's move, it begs the question, once again, are we going to at least come down and test 180 on the IWM? And are we going to move even lower? Are we going to go down to that 100% extension? It's a really well-formed zigzag pattern, and I think you have to keep that in mind, that there's a distinct possibility the IWM comes down to that 100% level at 175. And if you've been watching us for a while, you know that there's been a ton of consolidation and congestion through that level, with the lower end being 170, the upper end being 180, right in the middle where all the trading's been, 175, right there where the 100% extension is. So something to keep an eye on. Well, if you've been watching the news at all, you know that UAW went on strike. I wasn't sure they would actually go on strike after all the hoopla that's been going on with the Screen Actors Guild and everything that's been going on, the writers in Hollywood, etc. But they did. And so we got to look at stocks like Tesla, as far as where can we find something with a bid to the upside. And it was a down day on Tesla, but not significantly so. And you know, we've got oil moving to the upside, which is significantly higher. And you get the UAW strike on top of higher oil. You would think that a lot of the EV makers, including Tesla, the leader of the group, would be performing better, and they are. They are outperforming the market. We have that wave 4 right at that strong 61.8% level, the same thing we were talking about on the VIX, and we're up at a little bit of resistance here on Tesla at 280. But we're a bit overbought. We're just a tiny bit overbought. Another one of those rules, no security in any time frame gets too far away from the 10-day moving average. So we got a little bit overbought here back on this big move on the 11th of September. And so now we're consolidated for 3 days, and that's pretty good price action. Let that 10-day moving average catch up. Even if we pull back a little bit, not a big deal. So if we can consolidate here under 280, let the 10-day moving average catch up, rebuild some energy and momentum. Perhaps we do break above that 280 level and start to make a run up towards that wave 5 target that's up there around 340. It's not out of the realm of possibilities with everything else that's going on. All right, so that's the EV makers. Let's take a look at GM. So you can see that we had a bid even in GM today because of the strike with the UAW. Now, it gave a lot of it back, so we came down and closed back here right at this area of support resistance on GM at 34. So trading above it was pretty interesting. Didn't turn out to be something that you would want to look for a trade just yet, but perhaps next week we can get above 34, and you can see on this move to the downside here was so significant that if we can get a bid here, then we could have something to the upside on GM. But the fact that it traded back down and closed below 34 took a little bit of that shine or excitement away from the early movement in GM today. So if you're looking for a stock in the auto world other than something that's purely an EV play, GM is not a bad place to look, but it's got to get above 34. We got to close above there. In stocks of interest today, lots of talk about Adobe had earnings, and they were kind of disappointing. And that really makes you interested in some of the other tech plays as well. So you can see that we had a wave 5. We didn't quite make it to the tap box, but with this movement to the downside here on its earnings report, hard to imagine that we don't come down at least to 520. I know it's not much of a stretch. We're like, you're really going out on a limb there, right? 520, we're not far away, closing at 525. But that is where support is. And if 520 doesn't hold, then there's a little bit more support here at 500. So we kind of have these 20-point blocks here, with the next one being 480. So there's a whole lot of support here between 480 and 520 on Adobe. So the strongest move would be obviously if we can hold above 520 and turn and bounce next week. But if we don't hold 520, then we have 500 and then we have 480. Now, if we don't hold 480, that is the old Katie bar the door time. If we don't hold 480 on Adobe, there's nothing there. It's a vacuum. We're coming all the way down here, probably to 380. If we can't hold 480, that's a 100-point drop in Adobe. So that's where it becomes really interesting. And we have this gap here that hasn't been filled yet. So there's a bunch of support here in the area of where we are with Adobe. But if we happen to break below 480, so watch out below there as far as where we could move to the downside. But didn't help itself today with a disappointing earnings report out of Adobe. Bitcoin kind of gave us a little bit of hope there. We looked over here on the 11th, and we're like, this is the fingernails on the edge of a cliff here at 25,000. Because if we don't hold that, once again, nothing. There's a vacuum. So Katie was busy with these two charts here, trying to keep that barn door shut on these potential massive drops. Accomplished the goal here, at least so far, on Bitcoin. So we're right around 26,000 at the time of this recording. So a little bit lower than where you see that bar, but still above 25,000, which is the last bastion that needs to hold. 26,000, which we are holding again at the time of this recording. We'll see how that plays out over the weekend. But we still have a little room down to 25,000. But if we're going to have some sort of run into the halving that goes on, halving this forecast for the first quarter of next year, we need to see Bitcoin turn and start to make a run. It has every other time. And is this going to be the one that breaks the trend or not? But at least it's holding in there. And I know y'all want to know about Coinbase. Seems like everyone that wants or has interest in Bitcoin is interested in Coinbase as well. Down day to day, but not significantly so, considering how bad the tape was. And you can see, look at that. The 10, 30, and 50-day moving averages all right there at that price we've talked about for weeks here on the market update at 80. Now, we did come down to 75. I had made the comment that back over in here in July, when we were way up here, that was too vertical. Didn't like that. Another one of our rules, what goes vertically up often comes vertically back down. And if we could see Coinbase back down at 80, that might be an interesting spot to get in. And we did come down to 75. We even went a little bit lower. Now we've gotten back above 80, but just barely. And the close today, 80.55. So in this 75 to 80 range is where Coinbase needs to hold. And I think as long as Bitcoin stays above 25,000, you could expect Coinbase to stay above 75. If they both give up the ghost, then you're looking probably down here around 60 for Coinbase, but we're not there yet, and we're not threatening it, at least not at the time of this recording on Bitcoin either, breaking below 25,000. So we talked about Adobe. We need to bring in NVIDIA with the fact that Adobe had a bad earnings report, and we're right at the level that have been commenting both on TradeFinder and our insiders meeting, because everybody asked about NVIDIA. 440 is where we need to hold there, and we're right there. That's exactly where we closed today. So if we're going to stay bullish on NVIDIA with any hope of moving to the upside, perhaps getting up into that 580 range, it's forecast not till mid-December, so there's plenty of time before we go there. But if that's going to happen, we need to hold somewhere in this area. It doesn't have to hold 440 because there's another level of support there at 420. And once again, dropping at these 20-point segments here, we have some support also at 400. Now there's a little support there at 380, so you could make a slight case of, you even got another 20-point stair step. But look what happens if we were to at least threaten 380. Then you have to bring in the gap. I haven't felt like that gap was in danger of getting filled for quite some time. But if we start breaking down through these levels, through these steps, then you have to start talking about it. It's still too early. I don't think we talk about it yet. Just wanted to bring that up because we have these blocks of 20 points here of support. Now, the most bullish case, once again, on NVIDIA is that we hold here at 480 and turn and move back to the upside, and then perhaps we can make a run. I would submit to you that if interest rates continue to move higher, that's going to be very difficult for NVIDIA or any of the other tech stocks, especially the ones that have such a premium built into them from all the AI craze, to continue to make new highs. We're going to need interest rates to back off a bit if we're going to see that kind of a move. And then last but not least, India, which if you're looking for someplace bullish around the globe, has been the market, in my opinion, to look at. And we had just a little slight pullback just to the 23.6% fib level. Elliott himself even wouldn't really call that a correction, just more of a pullback, going all the way back to the beginning of the move from mid-March. And we've just continued to power higher. We did break that wave 3 high. We've come down to test it just a little bit, but we were overbought. You can see the high of the day there on September 11th was a little bit of a gap there from the 10-day moving average. So coming back down, letting the 10-day moving average catch up, all that is very classic technical analysis in the Elliott wave world, as well as just plain old price to volume action with the moving averages. So even at 45, we're still holding above the 10-day moving average. And if we can stay there and hold that area, then we have a potential chance of moving up to that wave 5 target. But nonetheless, looking around the globe, you'd be hard pressed to do worse than putting some money to the long side in the INDA. And we know that a lot of manufacturing is moving from China to India. As I mentioned last week, I'd done a live webinar for some folks in India. And as you can understand, they are pretty giddy and pretty proud of what their market's been doing. And how can you blame them with a chart that looks like that? So that's it for this week. Hope you have a wonderful weekend. And obviously, what occurs on the beginning of next week, especially on Monday, it's going to have a lot to do with whether or not we confirm the downside breakouts of the triangles, or if we're waiting to see some other confirmation. So lots to talk about next week. Enjoy your weekend. Look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.